What's going on, everybody? Good morning and welcome back to Beat the Bell, presented by Kane Capital. It's been a minute. Hope you guys all had a phenomenal long weekend, and I hope that you're all having an awesome trading week thus far. All right, starting with Money Mander. Money Mander, good morning.
Good morning. Hope everyone enjoyed the holiday, and on to another episode.
All right, Diamond Trades.
Alejandro, what's going on? I hope everybody had a great long weekend. Let's go ahead and get after it.
Stock Snipa.
Good morning. Hope everybody had a great weekend, just like the other guys said. Got an awesome Bit the Bell for you guys today, and let's get to it and let's make some money.
And last but certainly not least, Matt from Rocket Scooter. Some technical difficulties there. We'll get that figured out. Let's go straight into Fed forecast with Mander and Diamond Trades.
Yes, sir. Yes, sir. Let's kick it off. Let's start with the economic calendar for this week. So obviously the market was closed on Monday for Labor Day. Factory orders came in yesterday. I'll touch on those in a bit. We have pretty light day today. We have ISM Services PMI at 10 o'clock. It's going to be high impact news for the day. And then the composite PMI at 9:45, a little bit lower impact. Beige book at 2 o'clock usually doesn't do much for market volatility, but something to keep an eye on. Then another Fed speaker at 3 o'clock. Non-farm productivity quarter over quarter. That's a final print that's going to come in tomorrow. 2 more Fed speakers tomorrow as well. And then Friday we've got inventories as well as the financial accounts. So really not a ton going on by way of high impact news for the week. Let's go ahead and check out the earnings calendar as well. So this week is going to be light for earnings as well. A few names that I will be watching personally. Express, love to shop. They're a great store. GameStop after the close. I know that everybody's a bunch of people are going to be focused on that one. C3AI as well. Just with the AI craze going on, it's one of the more promising ones for the future. So I'm sure that people will be tuned into that one. DocuSign and RH tomorrow after the close as well. Let's go ahead and dive into this week's trading. So markets have been relatively flat on mixed trading to start the shortened week. And to kick off the month of September, the Dow and the S&P are down 0.67 and 0.4% respectively to start the month since Friday, while the NASDAQ is holding on to gains by a hair, up just 0.25%. As I'm sure you have all heard by now, September has a seasonal tendency to be a difficult one for stocks. Our friends at UW tell us that on average of the last 10 years, the S&P has returned a negative 1.64% in the month of September as the market gears up for fall. The narrative is often the big Wall Street folks, return from the Hamptons and put on these market-moving trades that produce a bunch of volatility. A moniker that, like many other in the stock market, seems a little bit too simple to be true. But the numbers are the numbers. Historically, September is the worst month for stocks, at least over the last several decades. So something to watch out for as we head into this month. September doesn't only start a month of rocky trading and pumpkin spice season, but it also tends to mark the start of an increase in seasonal volatility, according to Nomura. The volatility index, which measures the cost of downside protection in the S&P 500, is sitting at the $14 range, which is the lowest level that it's been at since the COVID crash back in 2020. The VIX generally has a negative correlation with stocks. As we head into the end of the summer with the dollar surging off of that $100 level and the benchmark 10 years sitting comfortably above 4%, many are wondering if this time will be different. Mander, what do you think we have in store?
I think you struck the nail on the head with the last two there and not necessarily the VIX. And so I'm sure Matt will cover that in a second, but obviously the VIX has just been in continual decay. I don't think that's a really good gauge right now as a potential volatility-inducing event to see downside. But I think if we're going to look at seasonality and what could give us some downside, we have to look into the dollar and the yields and energy prices. So I'll start with energy. Saudi Arabia and Russian officials, if we go all the way back to May, at the May OPEC meeting, they cut production because obviously Saudi Arabia and Russia's economies, they pretty much based entirely off of oil exports for their economy. And so with the global recession, quote unquote, kind of hitting in and demand going down for energy, they had to cut production to keep the price artificially inflated. But what does that do for us here in the States? That goes straight against the Fed's kind of mandate and direction here to get inflation down. And so after they cut back in May there, you can see diesel is up 40% since May and crude oil is up 14% since May. So obviously that's kind of adding to this higher for longer sentiment we're seeing. If you looked at yesterday, energy stocks were through the roof, crude's running through the roof on actively traded futures. So that's going to be the first thing to go against what we're kind of looking to accomplish here in the States. And that is one of the things kind of sending yields and the dollar running. So the 10-year also cleared back through 4.25% yesterday. And the dollar's been on this massive squeeze lately, with the Japanese yen kind of becoming the latest international short target here. The Japanese yen just hit 10-month lows as traders are kind of anticipating that the interest rate differential between us here in the States and Japan, namely on the 10-year, is going to continue to widen. So right now, Japan's 10-year bond is trading right at 0.66%. And so for a while, Japan was kind of looked at as the holy grail of the international economies because they didn't really hike rates too much and they weren't seeing massive inflation. Their economy looked pretty good right now, but now as we're starting to see these yield differentials, the yen is getting absolutely crushed right now, sending the dollar higher. And so when you have energy commodities running, you have yields running, and you have a very strong US dollar, those are all going to put pressures on the stock market. So I think all of those kind of coupled with the seasonality aspect could hint at something, but I don't think the VIX necessarily would be something to watch because the VIX is just in continual decay. Even if we see kind of a flat day in the stock market, you're still seeing the VIX down as we kind of trade in 3-year lows now. The one index I would look at for a volatility would be the MOVE, the MOVE, which is the bond market volatility index. I think that right now has a much stronger inverse correlation than the VIX does. Obviously, the stock market hates bond market volatility. And so really in either direction, but namely to the upside, if yields start squeezing, it's going to move that MOVE index, the bond market volatility index, up. And that is going to see definitely downside in the stock market, at least in the interim, in a short-term perspective. So really, if you think about it, anytime yields are really squeezing, it's going to be because something is brewing under the surface that wasn't previously priced in. And so, as of late, it's been everyone was getting really eager on rate cuts from the Fed. Now that's getting pushed out into May, potentially June of next year. We're seeing the higher for longer. That's sending the yields higher. Really, anything that's going to go on that's going to squeeze yields is going to move that MOVE index up on bond market volatility. And that is really what the stock market doesn't like. So it's kind of interesting. We're not seeing a great correlation between the VIX and the stock market, but really this MOVE index in the stock market is one thing I would be watching as we kind of move into September, which, as you said, is historically one of the worst months for upside in the stock market.
Right, I agree. I love your point about the VIX. I mean, to be completely honest, the VIX is a piece of shit. So I don't hate that take. And yeah, I agree. I think that when you look at like seasonal tendencies and things like that, like that for me is not enough to just say, okay, time to grab puts in the S&P 500. But when you lay out the backdrop like you have today, it sort of makes sense to at least consider the fact that maybe we don't, just resume this aggressive uptrend that we've had for, the latter part of the year here so far. So I definitely think it's something to take into consideration. That'll wrap it up for us here at Fed Forecast. Pass it back to Alejandro.
Guys, thank you. Going to piggyback off of what you were saying there, Noah. We're going to talk about the system and take a look at the recent sell signal that we got. So we, of course, got the bearish cross of the 10 SMA below the 50 SMA during yesterday's session. Important to note, though, we're still trading above the 50 SMA on the 1-hour chart. So today is really going to be a crucial day for the market. Bulls, of course, want to see the 50 SMA hold. We should be opening up right at around it based on where we're trading in the pre-market. But we did get that sell signal on the 30-minute. Something that's important to note as well that I don't have on the chart here, but that I should have prepared. But Noah mentioned, there's the possibility that we won't resume the uptrend that we were in for, the beginning of the year. And technically, that's exactly what has happened. We failed to regain that uptrend. So from March through July, guys, we were trading in a very steep uptrend channel. If you just take a trend line, you draw from the March lows through the June lows, through the May lows, you'll see that we were just trending higher and higher and higher. And in August, to start the month, we actually broke down from that uptrend channel. We back tested it on the end of August, okay, during that last week, taking a look at the chart there. And we were unable to get back in that uptrend channel. So that is something that bulls are really going to want to look for. So just picking your spots, being careful if trading long, understanding the risks, understanding that right now we're really in a corrective, choppy move as the market kind of reprices after what was a massive, massive rally. Okay, so let things kind of play out. I think, though, after today, we should have a better indication of the next trend leg based on what happens here at the 50th minute on the 1 hour chart. All right, guys, so that's going to do it for the system. We should have Matt with us now. Hopefully he was able to get there. He is.
Hey guys.
Good morning, Matt. How you doing?
Good morning. How's it going?
It's going great. All right. Excited to have you back on the show. Let's talk the talk. Let's talk Rocket Scooter. Let's talk commitment of traders. If you don't mind just running through your whole thing.
Yeah. Since, as you guys know, the commentary this morning was pretty accurate. If you guys can see my screen, I'm sharing. I'll just pull up straight the monthly map on the SPY. So this is one of the things that we do have at Rocket Scooter. And what we do is we can forecast pivots into the future based on the options landscape when options expire. So this is how the risk landscape looks. Long story short, how to read this. It is just a choppy mess. For the longest time, you had a clear-cut bull side and clear-cut bear side. And the way that you read it is that if you see these darker gray boxes, if the bull side bottoms are sloping down, it means you have calls deeper in the money as time goes by. If the top of the light gray boxes go up, it means you have more puts that are in the money over time as well. So the idea is that when calls and puts are both sloping down, as you see, it's still bullish-ish, but it's not clean. The whole rally we had since the beginning of October, we had a nice clean bull run. As a matter of fact, whenever I called market bottoming is because we saw that bull zone developing here. So when we had obviously the Fitch downgrade, the entirety of this just got shifted around to a point that it just got like throwing a baseball through a glass window. It shattered, and it hasn't been the same since then. It's trying to be bullish, as you see over the next 4 or 5 days. It's still clearly bullish and clearly short squeezing, but it is no longer, it's in no man's land as time goes by. It used to have clear bull territory for a while. So right now the market is still digesting what it wants to do at this kind of local double top. And like we said, about a month ago, this could be the top of the year if we do experience that seasonal volatility. And of course, the bulls just stop buying inside of here. So another piece of evidence that we use, well, actually, let's look at QQQ really quick as well. Kind of analyze the same setup. And as you see, QQQ, again, shattered and messy. Normally, this thing is beautiful and clean. So you can see that this is the moment in time that the market is uncomfortable where we are. That doesn't mean it's going to start selling off or anything. It's neither bullish nor bearish. It's still deciding. It's a big old blank space here. But in the shorter term, you still have deeper bull pockets, and then bears are still squeezing. So Qs are still very strong, at least for now, and I could still perceive this as being a call for the market pushing towards highs. Now, another thing to notice that the space between the bull and bear zones, when it gets bigger, it implies more volatility. So as time goes by, this will actually become more volatile, especially in the near term for the weeks and through the rest of September. Not going to look super hot. On the commitment of traders, looking at the future side of things, like look at the S&P 500. As you see, since about the end of July, we've been seeing some asset managers selling off. Let me make this full screen. The asset manager side is typically the long only side of the market. This is your 401ks, your IRAs, things like that just buy stock and sell it. So they've been amassing a net long position since October, and the market's been growing. Markets grow when stocks have buyers and markets are liquid. So at this point in time, they started selling. We started seeing a little bit of selling. Another thing to note is that the net contrarian side of the market, the leveraged funds that have maintained a very strong short against the market in batches have been squeezed, has become less net short as shown here. And those squeezes have propelled the market in little bear market rallies as you see through here and through here. So right now you can see that it's just kind of waving around with not a lot of strength, not a lot of new shorting. They have been squeezed in this last little bout here. So in general, you can see that there are still shorts squeezing in little waves every dip that we get. So it's likely people that have been shorting maybe through here for the whole year and they're upside down, just ready to abandon that position. But the question is, are we going to have new shorts starting to step in at the same time we're selling? Anytime these two lines slope down, that's bad news for the market. If you can look where my mouse is here, you can see that same thing. When everybody's selling against the house, which is the red line, then the markets tend to pull back. So right now we have to see if the shorts that were shorting earlier in the year are too underwater, ready to get out against the new shorts trying to jump in. Once everyone starts selling, that can be bad news. And as you see, at least locally in the last maybe 2 to 3 weeks, you have both of them ticking down, which is showing that downside that we've seen. So right now, is the market safe? It's in a very questionable phase. It's trying to figure itself out. And I think as time goes by, we're going to be very sensitive to catalysts, as implied by some of this volatility you see on the charts. So I'm going to be very closely paying attention to just about everything in the news, and we're going to be responding, I think, as time goes by, a lot more sensitive. We're going to be a lot more sensitive to the news. And despite the VIX being lower in like the 14s range, it could, if you start to see the VIX growing 15, 16, 17, another cool correlation with the VIX is that the sensitivity of the market to catalysts goes up as the VIX goes up, as the market is thinner and can absorb less of an impact. So with the low VIX now, it doesn't seem like a news event's going to shift the market anything other than sentiment. So if the market sells off in a bad news event, it's not volatility with a low VIX, it's actual sentiment-based selling instead of just a thinner market. So this is the time you really want to listen to a catalyst, because it's believable. If the market takes a huge 3% red day on a CPI reading with a low VIX, everybody's selling at that point. So.
All right, awesome, Matt. I appreciate your analysis. And the last thing I'd like you to talk about, I understand that Rocket Scooter has some new developments with the platform, and you guys have kind of redone, given it a new look. Mm-hmm. So if you don't mind just highlighting some of the new things that you guys have done.
Oh, yeah, absolutely. We have given the platform a brand new face. Actually, it's a new look and feel here. We have a lot of other features. We have connections to an automated Discord bot that's going to open up brand new features, interacting with the platform, you interacting with the Discord. One of the future things that we're going to have would be really neat is that, if you run the scanner with a couple of settings, it'd be neat if in the Discord you're to ask the bot, which will be powered by AI very soon, hey, give me the top 5 BLU stocks that are right on hedge pressure, and the bot will DM you back with the answer. So connecting your Discord bot's going to open those doors down the road for these bigger things. We now have futures trading and futures data coming into the platform. We're using CQG through EdgeClear. So you can now, as we're going to start adding different brokers you can connect to, trade through multiple brokers in the Rocket Scooter platform as well. So that's just our first one we have, and we're going to be adding more throughout the years. So we have futures data and automated futures alerts coming through now for different techniques that we've developed. So eventually we're automating all the things that we do teach and trying to get everything into the platform all at once. So a lot of really big developments have come out. And as the rest of the year goes by, just look for us to have more brokers attached, so more variety for those that want to trade through different brokers.
Awesome, man. Exciting stuff there. Thank you. All right, guys, we're going to move now to Bet the Bell with Stock Snipa. Take it away.
Good morning, guys. This is the best part of the show. Everybody knows that. I want to say a huge shout out to one of our members in the audience, Meatball23. What's up, man? I'm going to go ahead and start us off with our normal routine. We're going to go ahead and take a look at the statistics. We can see that Diamond is currently winning right now. We can see Alejandro's 1 win behind.
Really? I thought I was wrong on Friday. That's interesting.
What'd you pick?
I forget. We'll go back and check the tape. I thought I was wrong. Yeah, I picked red. I thought the market held on by like a string. I could be wrong. We'll see.
Okay, so our first question of the day, green or red? I'm going to go ahead and start this one off with Diamond Trades.
I'll go green for today. This is a coin flip. Honestly, we're trading in a range. And every time we leave the range, we get pushed right back into the range. So this is a coin flip, but I'll go green.
Okay, Mander, what you got? Green or red today?
I'm going to take the same. It looks like futures are down about 0.25% in both indices, but yields and dollar getting a pullback from yesterday. So I think we could see a little push. Slight green.
I like it. Slight green by Mander. Hondo, what do you got? Green or red?
I'm going green. We're coming into some heavy support today in the S&P futures, so I think we see a bounce.
All right, Matt, what you got? Green or red?
I think I'm going to stick to the side of red today. I think we have services PMI that can kick the market any direction, and then non-manufacturing PMI coming out as well. So we'll see. Maybe that'll go red. We're just go green. We're just slightly red, so it doesn't take long.
I like that. So I got an interesting question coming up, and we're talking about some news that have just came out. I'm not sure if everybody is aware of this yet, but we can see that Visa and MasterCard decided all of a sudden to increase their network fees. This will bring in an additional $500 million a year to Visa and MasterCard. My question for you guys is, what impact do you think we're going to see on our economy because of this increased processing fee? Do you think that we're going to start to see more places that are cash incentive or cash discount or other vice versa things? Because the merchants are going to be the ones paying for it, not the consumers. So this does hurt businesses. It does not really hurt consumers. I'm going to go ahead and start this one off with Diamond Trades.
Yeah. So when you look at Visa, MasterCard, this increase that they're going to do in the merchant fees, right now they're estimating that that's going to lead to like a $500 million increase in revenues between the two companies. For two companies that do a combined 90 billion in this space in particular, that's like a 0.5% increase. So obviously you can't knock it, no cost upfront to them. Small businesses are going to pass some of the costs along to the consumer, Snipe. So they actually do, they don't take the full hit of it. The merchants, they do pass some of that off to the consumer. If you've ever been to like a small business and they say, if you use a credit card, you're going to get charged X, Y, and Z more. That's what that is. But yeah, they do eat some of that cost themselves, obviously. And so for small businesses, this will ultimately cause, lower profitability and, hopefully not put some of them out of business, but, it might for those that are really like right on the margin. So I think at the end of the day, it's something that the companies are going to continue to do because they can, and they can get away with it. And I don't think that this, will really stop until, either the government steps in and limits the amount of costs that they can put on these transactions, or, some sort of newer disruptor comes into the space and, offers a lower cost alternative.
I like it. Very educated answer by Diamond Trades right there. I'm going to go ahead and ask Matt the same question. What effects will Visa and MasterCard increasing their network fees have on our economy?
Yeah, I think that there was a time when you would go to a gas station or convenience store or something, and they wouldn't take a credit card if you wanted to buy a soda or something because the fees. And then they have now these bulk fee structures, I think, where you can do the small purchases. I wonder if that's going to be like that again, where you go places and it's cash only. It could be. It depends on how much it does hurt those smaller purchases. So I think in general that does have an effect. As far as on the economy goes, I don't know what other than people. I think it only affects like if you're buying like a small amount. If you don't hit like a certain threshold, there's a charge. I don't remember. I don't know exactly how it works, but I think that it'll affect a lot of small time retailers, and I don't know if it's going to hurt their business as much because people are still going to buy what they want to buy. We'll still have to carry more cash in our pockets, I think, for those of you for those smaller purchases out there. So
I like that. Money Mander, what do you think?
I'm kind of leaning on Noah's side here. I think if you just look at the revenues projected versus what they're already doing, it's such a slight increase that I don't see this running a ton of companies out of business. But I think it is worth mentioning, as kind of Matt and Noah both said, that I definitely could see a lot of places, if not already, going to a credit increase, basically a cash discount. I know a lot of places you'll see like 3% fees on any credit card transaction. I think that'll probably just pop up and be more common, but I don't see this like running companies out of business. You start to see the unemployment rate spike up because of Visa and MasterCard here.
So I got a follow-up question on your answer there. Same towards Diamond, but if you do see that 90 billion versus 500 million, yeah, very small increase. Why is everybody freaking out over it?
Well, I don't want to say it's a very small increase. Like it's a 0.5% increase, but you got to understand, like for companies that do 90 billion in sales, like that's what you're sort of aiming for, right? It's hard to grow a $90 billion, a company that does 90 billion in sales by 10% or something ridiculous like that. Like, they do it slowly. And that 90 billion is up from like 33 billion in 2013, just 10 years ago, right? So this is an industry that's grown, massively over the last over the last decade, and it's probably projected to do the exact same over the next decade. So, in the long-term story, I think, of these two companies, it's not necessarily like, can be massive news, but it's just a trend that, I'm sure that they'll do it again at some point down the road. That's what I said, is like, as long as they can do it, they're going to keep doing it. I mean, it's free money, literally. Like they don't have to increase costs to do this. They're just literally adding revenue to their business. So why wouldn't they?
I like it. I'm going to go ahead and ask Hondo now. What do you think? What are the effects of Visa and MasterCard increasing network fees?
Yeah, I don't think it's gonna be as dramatic or as drastic as people may be making it out to be. I don't think that it'll be felt too much, especially for the consumer. I mean, I think about all the times I would go to the convenience store and I chose to just use card over cash, despite knowing that I would have saved a little bit of money simply because of the convenience. And if we start to see that in other places, I really don't think it's going to change my personal habits. And hopefully it doesn't do too much damage to businesses, and hopefully they don't end up incurring too much of the heavyweight there. But I think that everybody else did a really good job of stating their points. So
I like it. So I'm going to go ahead and jump over towards my next question. Money Mander is going to love this one. But we could see that Tesla now has a new feature coming, or enhancements to the auto drive. It's said that people who own Teslas will be able to use their Tesla for giving people rides without them having to physically be there, and that they pretty much can make money through their car when they're not there. And there's also a bunch of other features coming out, and they're saying that you will be 100% hands-free, and this car will be completely self-driven. Now, my question for you is this going to be revolutionary, or could this be a disaster? If we have a road mixed with robots and with people, do we see some kind of problems there? What do you think we have in store for us in the future? I'm going to start this one off with Money Mander.
Revolutionary. So I don't love the cars in particular. I think this technology, though, is revolutionary. And if you look at the data, like the auto drive here and the FSD that Tesla has been baiting for a while now, has, I want to say it's like a 95% less accident margin than actual human error. If you think like the autonomous driving is going to be more dangerous to society than humans driving, it's completely the opposite. Human error is really what causes 99% of accidents. So if you take that out of it, I think this is absolutely revolutionary, especially where they're going with the AI, where it's pretty much teaching itself every single day how to get better and better at driving versus a human having to code it. I think this is really the whole point of the price cuts and then trying to get Teslas on the road, is to then go and push for this. Like you mentioned, it basically would be like you could Uber out your Tesla without even having to be in it, and just cash flow through your car and have it go pick people up and take it wherever. I think maybe in a decade, this isn't going to be an overnight thing, but I think it's absolutely revolutionary.
I like it. Diamond Trades.
Two things. One, the day that you're allowed to rent your Tesla out and just have it go like do Ubers for you and make money while you sit at home, that would be absurd. I don't know if we see that quite so soon, Mander. Second thing, I don't know why, but I immediately just started thinking about like back when you could jailbreak iPods. Like, what if you could jailbreak this system? And I don't know why, but like immediately I just started thinking about like if you were to jailbreak one of these FSDs and then have it like you were like robbing a bank or something and you were like trying to escape like the police. Like, I feel like that would be such a cheat code. Like, you have FSD on crack, literally like running away from, as Mander said, human drivers who are like marginally worse. I just think I feel like it sets up for a very entertaining set of circumstances if this were to come true. So yeah, I feel like both revolutionary and probably going to cause some problems.
And nobody would be at fault for driving.
There you go.
Wow. Yeah, Matt, what do you got for me?
I mean, like, I think all is good until the Skynet thing happens and the robots decide that they want to take over. And then they start, mowing us down with their cars at the end of the day. But other than a funny movie scenario, I think it's a great idea. I think that's going to revolutionize everything. And like Mander was the one that said it, that, human error causes so many wrecks. Robots are probably not going to be checking their Instagram for likes while they're in the middle of a freeway, causing pileups and, things like that. And also robot drivers aren't going to be rubbernecking to see, unless you're programmed to do that, what's going on in the wreck to slow it down so things speed back up. I think that all works out. That's going to be great. I mean, we'll all love taking a nap for everybody who hops in their car to go to work. I've kind of like since the early days of sci-fi waited for things like that to happen in my life. We didn't get our hoverboard after Back to the Future, but hey, we're getting our self-driving cars, so I'm excited about that to be part of the daily thing we do.
And last but not least, Alejandro.
This sounds so nuts to me, and hearing you guys talk about it, obviously this would be revolutionary, but it doesn't even seem like it could be real, like literally something out of a movie, just to see cars driving around without anybody actually physically driving them. But I'm starting to think now this could be revolutionary, obviously in a few ways, but transporting humans may be way further down the line. But I'm thinking, delivery services. How advantageous would that be for a company like Amazon to just throw their packages in an automated vehicle and have them go do the drop-offs? That would save them so much money. Unfortunately, it would take a lot of people out of jobs, but that is definitely something that I see us pushing towards. Even something as simple as like Instacart, where they deliver groceries to your house and you just have those groceries delivered in a Tesla. I mean, the possibilities are endless. Also, I'd imagine the lawsuits are endless, and there's definitely going to be some crazy stuff that goes on, but we'll have to wait and see how everything plays out.
Yep. That'll wrap it up for Bet the Bell today. I'm passing it back to Hondo here.
All right, guys. Appreciate you all joining us. Really appreciate Meatball23. That guy's great. He's always involved. Be more like Meatball23, everybody. All right. That's going to do it for us. Once again, appreciate everybody who tuned in. We'll be trading live all day in the King Capital Discord. You guys can go to king-capital.com or scan the QR code on the screen. Currently, we've got the Rocket Scooter QR on the screen. If you want to scan that, check out their platform. All of us use it to trade every day. Have vouched heavily for Rocket Scooter since last summer when we first met and interviewed Matt on TCP, and our relationship has been awesome, and it has certainly helped to enhance our trading. So if you are interested in what they do, if you're interested in how Matt trades, go back, rewind the tape, scan the QR, or just go to rocketscooter.com and you'll find more information there. All right, guys, we will see you back here on Wednesday morning at 8:30. Friday morning, at 8:30 a.m. Eastern time. Have a great rest of your day, everybody.